Okay, let's jump right in. Welcome back to the Deep Dive. Today we are really strapping in for a high-speed tour of decentralized computing. It's a story that's being defined by this one intense competition, the race for true blockchain scalability. And it's all being driven by the evolution of these things called virtual machines.
It really is. It's this fascinating mix of, deep computer science and just raw market pressure. We've gone through the source material, and it details everything from the architectural limits of the old Ethereum virtual machine, the EVM, to these radical new execution environments, things like the Solana Virtual Machine and Arbitrum Stylus.
And then we have to get into what is just a classic crypto confusion, the acronym XVM. I mean, it's being used for projects building critical, deep infrastructure and for these super volatile tokens that are just riding the speculative RWA hype cycle, RWA being real world asset.
Exactly. So our mission here is to be your guide through all that chaos. We're going to untangle the technical side of it, explain the architectural changes that actually unlock performance, and crucially, separate the foundational tech from the, let's say, market speculation. By the end of this, you'll understand why the old ways are hitting a wall and what the future of on-chain execution really looks like.
Okay, so let's start with the big one, the EVM. It's the machine that basically built the decentralized world we know. But our sources make it really clear that its first-generation design is now a major bottleneck.
Yeah.
It's like the V8 engine of the internet. Powerful in its day, but super inefficient and built for a much simpler time.
That's a perfect analogy. I mean, all the innovation that's exploding in the space right now is a direct response to the EVM hitting these hard architectural limits. We can basically boil it down to a few major problems that all get in the way of throughput.
The first one, and you could argue it's the most important, is the sequential execution model. Everything happens one after the other. It's just a single file line for every single transaction. Now, that guarantees everything is predictable, but it's a huge scalability problem because you can't execute two totally separate contracts in parallel.
Exactly. Think of a giant highway, but everyone's forced to drive in a single lane. It's a traffic jam by design. The sequential model completely prevents us from using modern multi-core processors. If you solve nothing else, you have to solve this.
And beyond just the sequence, the efficiency is a huge problem. The gas efficiency constraints they're painful. When you actually look at the EVM's instruction set, it's just not built for modern heavy-duty tasks. I mean, complex cryptography, string manipulation, even just basic floating point math, these things burn gas like crazy.
And that gets even worse because of the size limits. There's a hard contract size limit of 24 kilobytes. So developers are always fighting to squeeze their logic into this tiny box. If it's too complex, you have to split it up across multiple contracts, and that just adds overhead, costs more gas for calls between them, and makes everything more complicated to build.
Right, and the last piece is that data access is just so expensive. The high cost of state access patterns, it basically means reading and writing data to storage is just not feasible for data-heavy applications. If you're building something that needs to interact with a database a lot, the EVM is basically a non-starter from a cost perspective.
So the takeaway is clear. The EVM is, by its nature, single-threaded, expensive for complex math, small and bad for storing data. And the need to get past these limits, especially that single-threaded execution, that's what's kicking off this whole modular revolution we're seeing now.
Exactly. That need for a total rethink has launched this massive shift away from the old monolithic design, where one network does everything. Execution, settlement, consensus, data availability. Now we're moving to these specialized modular setups where those jobs are split across different layers.
And that split has allowed for a whole new generation of specialized virtual machines. One of the most interesting is Arbitrum Stylus. Stylus is it's trying to be a bridge. It keeps full EVM compatibility, but it lets developers write smart contracts in normal languages like Rust and C++1, which then compile to WebAssembly or WASM.
And the sources have a great performance comparison here. For really complex stuff, we're talking verifying an 82551 signature. The Rust version on Stylus used 75% less gas than the same thing written in Solidity. That is a massive jump in efficiency for complex logic.
But the nuance is really important, right? Because the benchmarks also show that for your standard, simple stuff, like a basic ERC20 token transfer Solidity, is still a bit cheaper on gas. So Stylus isn't some magic bullet. It's more like a surgical tool for devs who need that raw computational power without totally leaving the Ethereum ecosystem.
So what happens if you just throw out the EVM's sequential model entirely? That brings us to the Solana Virtual Machine, the SVM. Its killer feature is something called the C-level runtime, which allows for parallel transaction processing. Instead of one line, The SVM can run multiple transactions at the same time if they don't touch the same parts of the state.
That's the architectural flip the space was waiting for. If two transactions are independent, they just run simultaneously. And the way that works is that transactions have to declare upfront what data they're going to read or write so the network can schedule them efficiently. That parallel processing plus a localized fee market is what gives Solana its famous high throughput.
Then you've also got the move-based virtual machines, which you find on networks like Sui and Aptos. They work on a totally different idea called a resource-oriented programming model. What does that actually mean for you listening?
It's a huge shift for asset security. Instead of an asset being just a number in a smart contracts ledger, Move treats digital assets as actual first-class resources. The language itself has built-in rules to prevent things like double spending or losing an asset. It just can't happen by design. So safety and composability are enhanced from the very beginning. It's a completely different philosophy from the EVM's account model.
Okay, we've talked a lot about the Vs and VM, the execution part, but even with the super fast engine, the sources show there's a huge bottleneck that remains, and that is data availability, or DA.
This is the real scalability killer right now. You can have the fastest execution in the world, but your layer 2 rollup is completely limited by the capacity and the cost of its DA layer. We've seen cases where the L1 publication fees are over 90% of the total transaction cost on a rollup. It's staggering.
Ethereum is trying to adapt, though. The Denkin upgrade, specifically EIP 4844, introduced something new called blob-carrying transactions. So instead of rollups cramming their data into expensive transaction space, called call data, they can now post these data chunks, or blobs, which are up to 128 kilobytes each.
And the cost reduction is what's game-changing. It comes from two things. One, blobs have their own separate gas market, so it's cheaper. And two, this is the crucial part. The data is temporary. It only sticks around for about 18 days. This frees up a massive amount of space on the Ethereum L1 and kind of officially repositions Ethereum as the main settlement and DA layer for its ecosystem.
But the modular world has already gone a step further. We have Celestia, which is the first public network built only for DA. It doesn't execute anything. Its only job is to make data available cheaply and reliably.
And it does this with some really clever tech, specifically data availability sampling, or DAS, and namespace Merkle trees. DAS is the key idea here. Instead of every node needing to download an entire block to check that the data is there, which is slow light nodes can just check a few small random pieces of it. If enough of them check enough random samples, you can be statistically certain the whole block is available.
That's brilliant. It's like checking that a massive library has all its books just by looking at a few shelves instead of reading every single one. And this lets Celestia hit these theoretical throughput numbers, around 56,000 transactions per second, which just blows the initial EIP 48844 target out of the water.
And this modular approach lets you build these incredible hybrid chains. Take Eclipse, for example. It's being called Ethereum's first SVM layer 2. And it's like this perfectly engineered monster of efficiency. It uses the Solana VM for its speed and parallel execution. It settles on Ethereum for security. And it uses Celestia for cheap data availability. It's the best of all three worlds combined.
Wait, hold on. If the modular approach is so much better, why are some chains still trying to fix the old monolithic structure? Why not just use the SVM for everything?
That's where a project like Monad comes in, and it really shows this debate is far from over. Monad is a new layer 1 that is basically taking the EVM and re-engineering it from the ground up to be multi-threaded. They're adding a parallel execution directly into the core EVM, essentially unlocking the power of modern CPUs for the old virtual machine.
But how do they do that? How do you get parallel execution if the EVM is designed to be sequential?
They use a technique called optimistic execution. Basically, they just assume transactions won't conflict. They run them all in parallel first, and then they check for any dependencies or problems afterward. If they find a conflict, they just rerun that small handful of transactions. That strategy, plus their custom consensus mechanism, is aiming for single block finality and a wild target of 10,000 transactions per second. It's a massive bet on optimizing the monolithic design.
Okay, let's pivot hard now, because this is where the deep tech discussion just slams right into pure market hype.
Yeah.
We have this ridiculous situation where the acronym XVM is being claimed by two completely different things. It just shows how fast market narratives can take over.
It is peak crypto confusion. You have Identity AFLT, XVM, which is a super speculative RWA token, and then you have Identity B0 XVM, which is a foundational technical infrastructure project. Two totally separate worlds using the same name.
Let's start with the spectacle. VLT XVM is all about tokenizing real-world assets. Luxury watches, fine art, commodities as NFTs. It's built on Solana and uses the XRP Ledger for its speed and low costs.
And the market reaction has been, well, explosive. The sources say XVM surged over 120% in just 24 hours, with trading volumes over $6 million. All of that is fueled by this one narrative, that RWA tokenization is the next big thing.
But the sources also urge a lot of caution here. The traction is almost all speculation because the actual platform, it's still being built. And this is something you really need to see. A 34% team allocation, that raises huge centralization flags. The project's actual success depends entirely on them pulling off the really hard, boring work of verifying and storing physical assets. It's a high-risk bet on hype.
And you contrast that with the other XVM or the RWA XVM or the extensible virtual machine. This is pure complex infrastructure. This is a deep tech project focused on building modular scaling accelerator.
Right. You look at the Zero XVM roadmap, and it's all technical milestones. A white paper, a testnet, a mainnet launch in Q4 2024. And it's focused entirely on things like DA layers, roll-up operating system, ZK rollups. This XVM is defined by other sources as the core platform for things like DeFi, gaming, and supply chain management.
So you've got one acronym for a token representing a Rolex and the other for the operating system needed to build the future of finance. The gap between the technical reality and the market excitement is it's massive.
This whole deep dive really highlights the two major forces that are shaping decentralized computing right now. On one side, you have this critical technical mission engineers trying to break the old sequential model using parallel processing, modular design, and better DA layers like Celestia.
And on the other side, you have this immediate explosive market demand. You have investors rushing to tokenize everything, and that speculation just grabs any technical sounding name like XVM to drive hype, often, way before the tech is even finished.
And both of these forces demand speed and efficiency, but they move at completely different rhythms. We've seen that the future of these systems isn't just going to be defined by engineers building powerful new machines like the SCM or Monad. It's also going to be defined by what the market decides to call the next big thing, regardless of what's under the hood.
Which leaves us with a final thought for you to chew on. We're watching an era where the underlying technology, the VMs, the modular architectures, is racing to provide real utility at scale. At the same time, the speculative market is moving at light speed, often anointing a winner years before a product is even delivered. So the question is, which force will ultimately define success? Will it be technical utility that proves itself through real-world performance, or will it be sheer market momentum dictating the narrative? Which one will win out for the next generation of decentralized networks?